Yo, what's up, guys? It's your boy Looney, and today we're going to talk about what I do when a stock starts to feel overvalued. Maybe it ran up too fast, maybe it hit resistance, or just feels like it's due for a pullback. So instead of just selling or trying to time the top, I sell a covered call. And in this video, I'll break down exactly what that means, how it works, and when to use it. Now, quick shout out to the Discord. It is free to join. And I also offer a premium membership where I do one-on-one coaching, trade callouts, giveaways, and more for $8 a month. You can check it out. All the links are in the description. So let's say you have a stock in your portfolio that has been on a tear. Let's look at SoFi, for example. Past year up 165%, and that's insane. And that is a lot of momentum. And let's say you still really like the company, but you also know that stocks don't just go straight up forever. And that's where emotions start to kick in and you start thinking, should I sell and lock in profits? What if it keeps going higher? And what if it drops tomorrow? See, that's the struggle. Wanting to stay in the position, but also protect your gains. And for me, what I do in this situation is I'll sell a covered call. And it lets me collect income on a stock I already own while still giving myself some upside room. Now, I'll show you an example on SoFi. I also have one on Riot that's working pretty good. And the reason I want to show you Riot as well, because SoFi is green today, and the other stock I'm going to show you is red, and I'm able to capitalize with using covered calls. But what is a covered call? And let's actually go to trade options, and we can just choose. Actually, before we even do that, you could actually learn about it on Robinhood itself. It goes over it here when you click on covered call, and then you hit this question mark. It goes over what it is. But in short, or in basic terms, a covered call is when you sell a call option on a stock you already own. See, each contract is 100 shares. And with that, with selling that call, you're basically agreeing to sell your shares at a certain price. And that certain price is the strike price. So if the stock gets to that price by expiration, then you will be forced to sell it. Now, for doing that agreement, you get what's called a premium upfront. And that's cash that goes straight into your account instantly. And if the stock stays below your strike price, you keep your shares and the premium is your net profit. Now, let's say the stock goes above your strike price. You'll likely get assigned, meaning your shares get sold at that strike price. But of course, you still keep that premium. So that's an important thing because yes, covered calls are considerably a bullish strategy. The issue is if the stock runs up too hot, something like Robinhood, for example, is a stock that runs up quite significant, you could run past your strike price and you'll be forced to sell your shares. So that's what's important. You have to choose a price that you're comfortable selling and you're not really trying to time the top. But it's a great move when a stock feels overheated or you just think it might go down. So let's look at today, because today SoFi did do really well and it went up. It didn't go up significant, but it did go up today. And usually green days are a good time to sell a covered call. I like to do it when it reaches above the Bollinger Bands and I have notifications turned on so that it tells me when it does go past the Bollinger Band, because that usually says that it is oversold. And even RSI, same idea, tells you if things are oversold. Now, that's not like that always works, because even if it does go past the RSI or the Bollinger Band, it can still keep that momentum. So that is important to note. But overall, that is a key indicator that I do use. So if I go to my trade alerts or indicator alerts, I have it set to here. So you can see if RSI goes above 70 and if the Bollinger Band if it exceeds the Bollinger Band. But we could still do it today. Today would be an okay setup because it is a green day. So we can see here that SoFi is trading at $29, pretty close to $30. And what I like to do is I like to do 30 to 45 days. Now you could do anywhere from 1 to 6 weeks. That is the kind of the golden ratio for selling covered calls, because if you do too little, the premium's not worth it. If you do too much, you often, again, the risk to reward is not really there. So the 30 to 45 days is great. You can do less. It's a little bit more management. So I like to do 30 to 45. Now, today is October 31st. It's Halloween. So let's go about a month. Let's actually do December 5th. Now, you're going to make sure it's a sell call. And once it's like this is where you're going to choose the strike price. Now, when I went back to the advanced chart, you can look at the Bollinger Band and see where the stock is not likely to go past. But what I like to look at is delta. Delta is pretty similar to chance of profit, and it just tells you its chance of being in the money, which in selling options is not a good thing. You don't want to be in the money when selling options. But ideally, I like to go anywhere from 15 to 30. That's kind of a wide gap. But I think the sweet spot is 0.20 right now, just because of how bullish the market is. We are seeing a lot of bullish momentum. So being super cautious with deltas is important. Now, what would I choose? If I were to set this up and the market is closed, I can't even do it, but I would do like a 15 delta or 16 delta, it's $37. And so this is what happens. So I'm agreeing to sell SoFi at $37 if it goes past 37. So if it goes to 50, if it goes to $100, then I'll be forced to sell at 37. I don't lose money, but I just miss out on those gains. So you can see it's very important you're choosing the correct setup. And if you're really nervous, you can do really low delta, something like 40 strike call, and you're only collecting a smaller premium. The 0.23 times 100 is $23. So you're collecting $23. But for the sake of this video, we're going to do one that's a little bit more realistic. So this one that you're collecting $45 in premium that goes to your account. And again, if the stock runs past 37, you're forced to sell it at 37. But hopefully you bought SoFi at a cheaper price, so you're actually locking in a pretty decent profit. Now, let's say SoFi dips or goes sideways or slightly goes up. Then that's the best scenario. Or the best scenario is when it slightly goes up. But either or, they all work. You collect that $45 or that premium, and that is your net gain. Now, when selling options, time is on your side. So you definitely have to be patient. You have to wait for the option to decay or theta decay, and you want the option to expire worthless is the scenario that is ideal. So yeah, that is the couple scenarios that you get. And I'm going to show you an example that I have set up on SoFi. I have a few on here, or I have one that's in the money. This one I'm actually having to roll, and roll is a pretty advanced strategy. We're not going to go over it in this video, but you can actually manage your position if the stock runs past your strike price, and you could roll it for a net credit or a net debit. I don't do it too often, but I like SoFi, and I think SoFi is a good long-term hold. So I don't want to get rid of these shares, and that's why I've been rolling it. But let's look at this $44 call. For doing this trade, I got paid $20, which isn't a lot, but that is consistent. That is a consistent gain, and it's going into my portfolio. I could do whatever I want with that $20. I do have to just wait. I have to wait for this to decay, and this expires the 21st. So a little less than a month, about 20 days out, and I'm okay with that. I'm okay with waiting 20 days. And also in 20 days, it is pretty unlikely for SoFi to go past $44. And we could look at when I set this trade up. So I set this up on the 23rd. You can see here, date sold is the 23rd. And if we look where the stock was trading at on the 23rd, it wasn't trading at a super high point, but we could see that it jumped pretty significant on the day. It jumped around 7%. And those large green days are usually a good time to sell covered calls. Now, you could have waited here, or I could have waited here to get a more ideal setup, but you can't time this perfect. And also, if we look at the 1 month chart, I don't know if I got notifications for that setup, but let's see if it actually was the 23rd. It wasn't a perfect trade, but it was trading close to the oversold levels. So the setup's not super important, but it is worth noting. You do want to trade it when the stock is kind of overbought or in an overbought situation. So for doing that trade, I got $19. If it stays below, I net realized gain of that $20. But let's say SoFi goes past 44 and it goes to 50, that's where things get interesting. And I have to decide. My initial strategy was that I'm okay with selling it at $44. So I really need to double down on that. I need to make sure that that's actually my strategy and my goal. And that's probably what it is. If SoFi jumps up to 44 in 20 days, then I'll most likely sell 100 shares and lock in a profit of 4,400. And I don't know what the exact profit is, but I bought these for $11, so somewhere 3,000, maybe even more than 3,000. And that's pretty interesting. So we'll see where SoFi ends up. Another one we want to look at is Riot. Riot is another stock that I own, and it has done pretty horrific in the past week, down 5%, and it's a crypto mining stock, so it is pretty volatile. Now, I set up a high covered call, and this one expires in 14 days. So for this $35 call, I collected $36 in premiums. So the premiums are a little bit better with Riot. It's a more risky stock, so there's a chance that the stock jumps 10% and also go down 10%. But let's actually see when I set this one up. So I set it up on the 13th of October. And if we go back to October 13th, it wasn't a massive green day, but the real green day was towards the 6th. And then it sort of traded sideways on the 13th. But you can see timing isn't everything. I didn't time this perfect. And it's looking like the trade is going in my favor. Ideally, you want Riot to subtly gain and maybe get to like 25 and get close to your strike price, but not actually hit it. The worst case, or it's not the worst case, but if the stock drops, that is an issue. But at the same time, if you were just simply holding it, you would also lose money. But covered call actually helps a little bit. It's not a full-on hedge, but it does help slightly. You can see here that although I'm down on the day 1,000, I'm actually up almost $500. And a lot of it has to do with these covered calls. For example, this $16 call that is in the money, or what? Yeah, well, it is still in the money. Its break even's actually above. So you can see here, this one gained pretty significant, 364. And this is another example where I am rolling my covered calls. So why do I love covered calls? Just quickly going over everything. One is that they work best when you think a stock is near short-term highs. The other thing is you're neutral to slightly bullish on whatever asset you are trading. And lastly is you could generate consistent income. It's similar to a dividend where you could reinvest those gains. So it's not about timing the top. It's about being strategic. And I use this move a lot on stocks that feel extended or overhyped. Like after a strong earnings run or when sentiment kind of gets too greedy. And it gives me a cushion during pullbacks and keeps my cash flow steady even when the market chops sideways. So another one we could actually look at is Webull. This one I'm not going to wait for a super green day. And this is the wheel strategy. So you sell puts to get in, you acquire the shares. I acquired these at $12 and I sold a put and I got assigned. Now, once I get assigned, I'm going to sell a covered call and ideally it's going to be above my cost basis. It's not showing right now, but it should be either $11 or $12, somewhere around there. And I'll probably sell a covered call at $13 about a month out, or $14. Well, I'm curious to see where this actually trades market open on Monday, and I'll collect that premium. And if the stock does go past it, I'll sell these shares off for a pretty good profit. So next time your stock feels overvalued, don't just panic sell or do nothing. Look at selling a covered call. Collect that premium, stay disciplined, and let time work for you. Another thing I want to mention before we end this video is that position sizing is important. Now, I went over covered calls, but it's also important to know that not all my shares are covered. And leaving some shares on the table is actually really beneficial because if the stock does run up, you're not in a situation where you feel like you made the wrong move. So if you found this video helpful, leave a like, comment below what stock you'd sell a covered call on, and subscribe for more smart trading breakdowns. Until next time, peace.